Hello everybody, this is Toni Turner and welcome to the market now as of about 11 a.m. Eastern on Friday, March 31st. And the end of the first quarter. U.S. stocks are trading slightly lower so far today. We're being dragged down by technology stocks as investors and traders lock in gains of what is likely to be Wall Street's strongest first quarter performance in 4 years. Strong economic data and the possibility of fiscal stimulus under President Donald Trump have driven U.S. equities to record highs. This quarter, the S&P is on track to gain 5.8% and the Dow 4.9% for the first quarter ending again today at the close. These numbers represent the index's biggest quarterly gains since 2013. As stocks continue to rise, investors are looking to these first quarter earnings season to justify Wall Street's high valuations. The S&P 500 is trading at about 18 times earnings estimates for the next 12 months against its long-term average of 15, according to Thomson Reuters data. Okay, now let's look at 3 charts that could give us some insight into the week to come. The first week of the second quarter. We are now looking, as we usually do, at a daily chart of the S&P 500 SPDR, symbol SPY. This is the exchange-traded fund that closely follows our S&P 500 index. Now, as I captured this chart today, just a few minutes ago, the SPY was trading at $236.09. This is about $23.60 on the S&P 500 itself. As you can see, it's jumped up off of its 50-day moving average this week after first falling to a low on Monday of $230.61, or about $23.16 on the S&P 500. It dropped to this low at the open. Then it moved back up to close above the 50-day moving average, and that is certainly positive. As you can see, the red line on this chart, the 20-day moving average, is coming down overhead. When I captured this chart, again, the SPY was trading just at maybe a cent or two under the 20-day moving average. Now, we can note that as a very short-term negative, the 20-day moving average, which is considered to be a short-term trend line after a fashion, the SPY is trading below it, and the 20-day moving average is moving down at this point. Just wanted you to see that. However, our 200-day moving average, of course, is still rising from below. And again, our 50-day moving average, the green line on this screen, is coming in here at $233.78 today. As you can see, the 50-day moving average can provide at least potential support for an asset. It did very well for the S&P 500 this week, kind of white-knuckled it back up and over again. Now, as we know, the SPY made an all-time high back here at March 1st of $240.32, or 2,400 and change on the S&P 500 index. Now we see that should the SPY come back and fall below the 50-day moving average, there is potential support here at about 232, more potential support at 230, and that goes all the way back, should I be able to draw a straight line, to this little bump up, this little January high, little move up we saw here. And of course, we have more support down at this area at 225. Now, I would not like to see, for the sake of the market itself, I would not like to see the SPY fall down and move not below 230. Really, 225 is key support here, or 2250 on the S&P 500. We don't want to see it move much below that line, as that will give up some potential key support area here, price support area, and that could certainly indicate further downside. On the other hand, if the SPY can hold above its 50-day moving average, especially going into next week. Since it bounced off of it, it's losing a little of its mojo today. But if it could keep rising, come back up to 240, and even start higher, perhaps during earnings season, if we have good earnings, and we're supposed to, then perhaps this uptrend, this bull market continues. So we need to stay tuned here and see how earnings come in. And that will all happen starting about the first week in April. Okay, our next chart for today is we're going to keep watching the IWM here. This is the iShares Russell 2000 Exchange Traded Fund, symbol IWM. As you all know, the Russell 2000 Small Cap Index is an index of stocks that are basically, most of them are based in the United States. So as I've said to you before, we can say that this kind of represents pretty close to a purely U.S. index. Now, IWM is interest rate sensitive, as many small companies, of course, do need to borrow money. So if interest rates goes higher, that doesn't usually make the IWM very happy. Although it has stayed fairly resilient in the last month. It hasn't been as resilient as, certainly not as resilient as the tech stocks or as the S&P 500. Now, we know the IWM made an all-time high on March 1st of $140.36. As I captured it today, it was trading just above the 50-day moving average at 137.14. That moving average we're looking at, that 50-day that's so important, is $136.86. So we're just right now just barely above this line. If at all possible, we want our assets and our indexes to stay above the 50-day moving average. This is known to be more or less an intermediate trend line. It is widely watched by a lot of the institutional traders that actually move the markets. And it's just a real good, baseline to have our assets and indexes trading above the 50-day moving average. Then we know they're reasonably healthy. Should they fall below it, then we have to get more cautious. So we see today this tiny red candle of the IWM, so far today at any rate, trading just above the green line. Would like to see it stay above this line for at least 4 or 5 days. It's certainly longer. Then perhaps, even if good earnings help, it could come back up the IWM and trade above 140 and even take off again. And that would be a very big positive for the broader market, as the IWM can many times act as a leading indicator for the broader market. And that's a lot of reason I look at it or watch it. Now, or monitor it, which I do pretty closely. And should that all happen, all that positivity, then I will exhale, because if the IWM is doing well, then I'm a happy camper. Now, should the IWM lose this 137 line, lose the 50-day moving average, and move back down to this support line here, key support comes in at 133. Should for any reason it come down, lose altitude, and fall below 133, then I can suggest that that could be a slightly, or at least a negative indicator for the broader market. So keep an eye on the IWM next week as kind of a leading indicator. Okay, our next chart today is one we haven't looked at in quite a while. This is the Select Sector SPDR Consumer Discretionary ETF. This again is one of the sector SPDRs. There are 11 of them that form the sector SPDRs, and this is the XLY Consumer Discretionary ETF. Now, this gives us exposure to U.S. companies in the automobile components, household durables, apparel, hotel, restaurant, leisure, media, and retailing businesses and industries. So it cuts quite a broad swath across the discretionaries. Top components in the XLY include Amazon, Home Depot, Comcast, Disney, McDonald's, Priceline, and Starbucks, and others you would know. Now, the XLY started this year. It started this year down here where you see the dotted line is. It started this year near the December lows, and it opened 2017 at $82.05. Now, since then, it nicely moved up its 20-day moving average, recently fell with the rest of the market back down to its 50-day moving average. Note how nicely it stayed above this 50-day moving average. And if we look left on the chart, we can see that it did the same thing at the beginning of the year. Now, in earlier last November, it did fall below, but most stocks did, as this was the week before the election, and then the big move up that I'm sure most of you remember. So recently it has come back down to its 50-day moving average, and it's bounced nicely off of it, a good sign. Now, again, when I captured this chart, the XLY was trading at $88.01. This is at its all-time highs. If we look down here, we see volume is very strong for this particular asset, for this particular fund. At least in the last few days, it's really moved up nicely. The RSI is hooked up. The MACD is near its zero line and hooked up. In an ideal world, I would prefer that the XLY move from where it is back down toward 87 and maybe even a little below it before I enter it. But I want to make sure my line in the sand, as you all know, is that it remains above the 50-day moving average, which today comes in at 86.20. That's where the 50-day comes in today. Now, for short-term traders who don't just buy and then just say, I'm holding it for the long term, I'm not going to look. For short-term traders, and we teach this kind of thing in Toni's Market Club, which I'll talk about a little in a few minutes, a little later. But note here with me that we have 1, 2, 3, 4, 5 green candles here, and a very typical pattern. The one that first bounced off the 50-day moving average, and that would have been Monday's, was a nice long green candle. Tuesday, nice long green candle. Wednesday, a little shorter green candle. Thursday, just a little shorter green candle. And today, so far, a narrow candle. And much narrower than the one that was starting. And this is a very typical pattern. As you see, buyers are enthusiastic in the beginning and then taper off a little bit as price moves up to nearby resistance. And we have to count the days. 1, 2, 3, 4, 5. 5 days are a Fibonacci number, but if a stock goes up or an ETF goes up for 5 days, then we know there may be a little pullback or consolidation involved. So that's why I'm saying for short-term traders, I'm going to watch the XLI into next week. I would prefer that it moves down a little bit for me to buy it, maybe to 86.50, maybe down to 87, 86.50 in that area. Of course, if it moves below the 50-day moving average, I don't want it anymore. But if it remains above that 50-day and starts to move higher, it may be something that I want to look at in the coming week. Also, when you get in the middle of earnings season, it can be a good thing to do to be in ETFs a lot of times when you're getting into new trades instead of single stocks, because that way exchange traded funds are highly diversified, and if one of the companies in the ETF takes an earnings hit, it doesn't hurt nearly as much as if you are in that stock, in that single stock. So if most of the stocks in consumer discretionary have good earnings, it will go higher, but you don't have to wake up in the middle of the night worried about your stock falling on earnings. Okay, now, at any rate, in the longer term, if the market remains bullish, we could see the XLY break higher here. Again, if it moves below the 50-day moving average, I am out of this trade. And now on to next week's economic reports. But first, please join us on Monday, April 3rd, for our next session of Toni's Market Club. We'll talk about which side of the market to trade as we go into earnings season, have a mini trading lesson, and I'll give you stocks and ETFs that may become ripe for high potential trades. This is a low-priced, high-value opportunity for you to learn more about the market, for you to become a smarter trader, and for you to make more money. So please join us. For those who cannot attend our live session, not a problem. The recording of our session is available to all of our members just a few minutes after the session ends. For more information and to join, go to tonysmarketclub.com. And now for economic reports this coming week. On Monday, we have the monthly ISM, or Institute of Manufacturing Index. We also have auto and truck sales. Tuesday, we don't have anything of import. Wednesday, we have ADP Employment Change, ISM Services, that's the Institute of Supply Management Services, crude inventories, and the FOMC minutes, which have been known to move the markets. Thursday, we have our usual jobless claims and natural gas inventories. And on Friday, we have our monthly jobs report, which usually catches a lot of attention. Again, join us for Tony's Market Club this coming Monday. Don't miss out on this terrific opportunity to raise your trading knowledge and your trading profits. Until next week, keep green on your screen. I'm Toni Turner, and this is the Market Now.